Thank you for joining us here on News 9, Aamar, and a great time to have you because the markets, we are all trying to make sense of what's going on. Today, this morning, it essentially opened at record high. It did, in fact, 22,600 is where we reached on Nifty. But from there on, we have seen a sharp drop of about 200, 250 points. What's going on, Aamar?
Yeah, that's a very interesting question. And also the way the markets open with a gap up almost 150 points and then the markets corrected. So that tells me that we have to be prepared for volatility. And also you have to understand one thing. And I would say our viewers need to understand one thing very clearly, that don't just get sucked in by the euphoria or by the volatility. Give the markets, whenever the markets open in the morning, at least give it first 15 minutes, let the markets settle down, because many a times the traps are set in the first 15 minutes of the day, either on the upside or the downside. So I would say even rather 15 minutes, look at a 30-minute time frame. Let the markets or the stocks consolidate and feel their level. Then you get into the markets, rather getting into on the go, expecting that the bullish momentum is there to stay. That's a very, I would say, very dangerous belief to have. Because most of the time, majority of the time, you'll find that the markets really trade the opposite way from the gap up or gap down. So having said that, if you look at the major indices, Axis Bank at a point of time was trading significantly higher. So that has corrected. Apart from that, if we look at from the highs, Axis Bank has corrected. If I look at HDFC Bank, HDFC is one which is still holding up. So that's one positive side. If I look at Infosys, again, sell-off in Infosys from the highs of the day. If I look at Reliance, again, from the highs of the day, Reliance has corrected. So most of the heavyweights, SBI also has corrected. They haven't corrected significantly, but yes, that correction is sufficient for the markets to really give up the gains. So if you look at the broader sense of the market, still that's in favor of the bulls. But yeah, and see, you have to understand one thing. Whenever the markets are trading at record highs, you have to be prepared for extreme volatility. India VIX comparatively, that's only at 11, 12 levels, so there's nothing much to worry about. But you have to be prepared for volatility. If you can stomach such sort of volatility, then you can be in the game. Otherwise, stay aside till there is some further clarity, because markets are going to remain volatile. And also, as we have more events lined up, we will see this sort of volatility there to stay.
All right, and I want to circle back on HDFC Bank, because at one point it was alone responsible for about 70-75% gains in both Nifty and Nifty Bank, and it was not just a technical breakout that we had witnessed a couple sessions ago. The Q4 business updates came in this morning, and they were essentially like, superb set of numbers. Look at that deposit growth of 26% year on year, 7.5% quarter on quarter. And Amar, that had been a pain point for banks, right? Poor deposit growth. Your thoughts, sir?
Yeah, I would say that definitely has been and continues to be a cause of concern for the banks. But we have to understand that investors are also looking at different avenues as well. Because if you see the way the mutual fund industry has been growing and the future also holds, apart from that, you look at the AIFs, you look at the PMS. So earlier, all these funds were more or less getting into the deposits, or in some form or the other, they were getting into banks. But that trajectory has completely changed. At the same time, the credit offtake, how that happens for the corporate, because there also corporates are, I would say, if you look at the Indian corporates, they are not growing at a breakneck speed. They are growing at a slow and steady pace, where they feel that they require, because a lot of them have burned their hands stretching themselves too far, too wide and too soon. So these are some learnings which corporates of India, apart from, I would say, the large corporates, medium or small, they've all learned through the hard way. So I think that also is there. And also we'll have to see, because ultimately it's also a lot to do with the employment creation, how that happens, job creation, how that happens, how the overall economic growth trickles to the last man standing. So these are certain areas where a lot of things needs to be done. But having said that, for HDFC, I have been saying that the worst definitely seems to be over. The low that the stock had made, that is a very strong support zone. So that was around, if you look at the low, that was around 1350 odd levels. If you look at the upside, 1550, 1560, that's a zone of resistance for HDFC Bank, where you could witness some profit booking. But the stock still is in a no man's land. It's more generally a trendless stock. So it's more of a trend play in this particular stock.
All right, HDFC is a trend play at this point in time, but seems to be out of the woods for now. And Amar, since HDFC Bank has posted such strong numbers, I mean, have you revised your expectations for other banks as well? I mean, which banks do you prefer, among this large cohort of private banks?
So if you look at a large cohort of banks, I would say Axis Bank is one which is quite positive even on the long-term charts. But again, in most of the banking stocks, post the rally in some of these stocks, because if you look at ICICI Bank also had a decent rally. But
Right.
again, it has gone in for consolidation. So now most of the large cap and these banks, I would say the bellwether banks or the leaders, they are showing signs of fatigue. That is clearly there on the charts. So except SBI still continues to be stronger on the charts. But again, I would say it's early days to say that it's formed a top on the intermediate term trend. But amongst all these banks, SBI is comparatively better placed compared to the private sector banks, be it I would say ICICI Bank or HDFC Bank, or I would say for that matter Axis Bank, or for that matter even Kotak Mahindra Bank. So most of these large banks are witnessing, means investors are not really ready to play a long-term bet on these banks at the current level. That clearly is visible on the charts also, and that we'll have to see. Now the data which the business data that has come out from HDFC Bank, we'll have to see how this, because it has to set a pattern, because it has to
Right.
set a momentum. It can't be a one day surprise. It has to be whether it's a regular thing or whether it's just a one-off case. So we'll have to watch out for that as well.
All right, and Amar, another space that we are tracking is the IT services, I mean, information technology services stocks. And yesterday when the market was falling, it was the IT stocks that provided, some bit of support. And Amit over here, what was the big news? What happened as far as the IT stocks were concerned?
IT stocks in the last 1 year, Suyash, have not really performed. Even the Nifty IT, around 27% gain over the last 1 year. Now, the US-based global brokerage firm CLSA upgraded its counters for the IT pack in India, and specifically they said the standout performance is going to come from TCS, which is going to be the top performer amongst the pack. And the target call for TCS, CLSA raised it to 4,043, up from the earlier 3,925. But the upgrade was to an underperform from a sell call. The next that the target that they raised was of HCL Tech, which was raised to 1,553, up from 1,536 earlier, again to an underperform from a sell call. The third one, which they had already given a big outperform call earlier on, was Tech Mahindra, and they reduced that call to a buy call, and the target was reduced to 1,508 from 1,518. Now, that is basically it. Amar, my question is it because this pack has not really performed, and even in the last 5 days, if we look, most of them are floundering in the either slightly in the negative or just above zero as far as gains are concerned? Is it because of that CLSA feels that it is time that this pack is going to basically have conservative gains in the times to come?
Yeah, I would say if you look at the overall macro of the IT stocks, I would say primarily the major ones, we are seeing that there is definitely concerns with regard to going forward in terms of the revenue growth, in terms of the bottom line growth, top line growth, and also in terms of the orders. Because having said that, US though is seeing some good decent growth, but there's a lot of structural changes that's happening, and also in terms of the order flows, that is a concern there. And also what we are seeing is that the way technology has been evolving, and the way going forward, how these companies are able to really cope up with the future, next 3 to 5 years, that's going to be very interesting to watch out, because there we could see a lot of surprises happening. Because a lot of work which is being done by many of these companies, that might be redundant or might become redundant going forward to a certain extent. So how these companies really cope up with that also markets or investors from a long-term perspective, they are factoring in. Having said that, if you look at some of the major stocks which you mentioned, like TCS. Now, TCS on the long-term charts, though it looks good, but intermediate term trend, we are seeing consolidation. Short term, we've seen the stock correct towards 3,800, 3,850 levels. Currently, it's around 3,950. So it's more of a range play in TCS. If I look at Infosys for that matter, Infosys is comparatively weaker than TCS on the charts. So that clearly is visible on the charts. If I look at some of the other stocks which you mentioned, like for example, Tech Mahindra. So what exactly is Tech Mahindra doing on the charts? Again, it's not very strong on the charts. So what these major stocks, IT stocks are displaying on the charts is that investors are not really gung-ho about these particular stocks or this sector as of now. There would be some stocks maybe where there could be some interest depending upon how they really plan out their future and what are they exactly doing in their current scheme of things. And having said that, if I look at the Nifty IT, because ultimately that really tells us the broader picture. So there again, we are seeing consolidation. After the rally, again, it's around 35,000 odd levels, Nifty IT. It's more or less consolidation. So I would say that IT, you have to be very selective. We want to get into IT, don't expect some major returns, at least in the short term, unless we see some very positive developments coming from the US.
Do you see the IT companies going through a sort of a tectonic shift as far as their structures are concerned with the coming of AI and quantum and those sorts of technology and large language models, where India has been a laggard? So do you see a period where there will be a low phase in these companies where they are basically restructuring themselves to brace themselves for the new realities?
And that's a very interesting point that Amit made over there, because, you know, look at what happened in the US markets. It was the rally to record highs was primarily driven by this, you know, 4 or 5 tech stocks. So it makes sense for them to also shift focus to, what's the trend, which is AI.
And an interim period when this shift is happening.
Yeah, so if we look at the IT stocks and companies going forward, there's no doubt about it that the technology shift that we are going to see in the next 5 to 10 years, 10 years I would say is a longer period, 3 to 5 years is going to be something which is going to be extraordinary and phenomenal. So there is no doubt about that. And there how these IT companies are actually able to cope up with and really come up with so that they can manage their revenue streams as well. Because what's going to happen is that a lot of the work, which I said, which the companies, many of the companies are outsourcing to these IT companies, that they might start to a certain extent doing on their own. Because a lot of the activity would get automated, a lot of it would be very easy even for non-programmers to really take up that. So these are areas which is going to explode going forward in the next 3 to 5 years. So I would say, so there definitely is a challenge, but at the same time, every challenge comes with an opportunity. So we'll have to watch out how these IT companies really are able to live up to the challenge. And as you rightly said, we are behind the curve in terms of the latest technologies, no matter what we say. So there's a lot of catching up for us to do. So it's going to be interesting times for the IT sector as well as the overall industry at large.
Interesting times for the IT sector for sure, sir. But we are in a new financial year, and I have to ask you, what are the themes and the sectors that you are betting on in FY25?
So if you ask me, the sectors which are definitely going to be of interest is one is the tourism sector. That's an area which is going to be of great interest. So it could be the hospitality sector, it could be the airlines. So because the way we are seeing in terms of the Indian traveler, that number is going to grow multifold over the next 3 to 5 years. So those who are catering to these this segment is going to be see a lot of opportunity there. So that's one sector one can look at. The second sector which I see is the NBFC space. So there it would be a challenge for some of them, but how they are able to manage their NPAs. So that again is an area. Third is real estate is a sector which is expected to do extremely well. But that would be more dependent on, I would say, interest rate cycle and overall economy at large. But we are seeing a lot of growth happening across all tier cities, and also the way the luxury segment has taken off, and that appears to be there to stay unless we see some major tectonic shifts happening in the global economy at large, which could have an impact on our economy. So these are a few sectors. And lastly, defense. Defense and defense sector is one sector which, again, I would say, just like we've got some defensive sectors called FMCG, pharma, wherein even in bad times you find generally tend to find some solace in these sectors. Defense is also an area where we are seeing significant growth and opportunity there. But again, one needs to remember that not every price is a price to buy, not every price is a price to sell. You should ideally wait for some correction, meaningful correction, and get into the stocks. And also, if you're looking at from a long-term perspective, look at it like you buy 20-25%, and then again you buy 20-25%. And so you build a portfolio of stocks in a SIP form, and then you hold it at least for a 3 to 5 years, because just holding for a 1 year period is never a good idea, because that means you are timing the market from an investing perspective, which is never a good idea. But if you average it out, then you'll find that you are far better placed, and the probability of being on the right side increases significantly. So that's something one definitely needs to do.